Banks and other financial institutions have strict eligibility criteria when it comes to sanctioning a loan. This is because bad debts or non-performing assets are detrimental to their businesses. Before sanctioning a loan to a prospective borrower, every lender tries to ensure that the borrower has the capacity to pay the equated monthly installments, EMIs, in time and repay the principal amount. To do this, they look into your income documents, personal credit history, current assets and liabilities, and other financial details. Based on this information, there are three ratios that a lender will consider when calculating eligibility: fixed obligation to income ratio, FOIR, loan to value ratio, and installment income ratio. Loan to value ratio is the maximum amount of loan that a financial institution will lend you, and the installment to income ratio helps the lender to know the borrower's repayment ability. Let us take a detailed look at what FOIR is. What is it? It is also referred to as debt service ratio or debt to income ratio. This ratio shows the lender the proportion of a borrower's monthly income that is already being used to pay installments. It includes all the fixed monthly obligation that a borrower is supposed to meet. This is mainly your debt obligation, that is, your loans. Expenses such as rent can be considered depending on your income level. FOIR does not include statutory deductions from the salary such as provident fund, professional tax, and deductions for investments such as insurance or a recurring deposit. So, say you earn rupees 50,000 a month, you have a car loan EMI of rupees 15,000, your FOIR is 30%. Most banks keep the FOIR at 45 to 50% of the borrower's monthly income. What this means is that, assuming you need around 45 to 50% of your income for personal expenses, your remaining fixed obligation, including the loan, should be restricted to a maximum of 45 to 50% of a gross monthly income. This percentage can vary from lender to lender. For high net worth customers, this can go up to 65 to 70%. So, taking the income as rupees 50,000 and bank FOIR as 50%, a customer can take loans whose EMIs will total to rupees 25,000. Taking the above mentioned example, if a person who is already paying a car loan EMI of rupees 15,000 wants a home loan, if she ticks all the other criteria, she can get a home loan for which the EMI does not exceed rupees 10,000. What should you do? For a lender, the most risky loans, as the name suggests, are unsecured loans. An example of an unsecured loan is a credit card. Such loans will have stricter FOIR rules compared with secured loans. The lower this ratio, the better are your chances of getting your loan application approved. If a borrower's FOIR is high, lenders or banks take this as a negative. This is because it means that your disposable income after paying EMIs will be low, and this in turn means that the credit risk for the lender is higher. A low FOIR and a high credit score is the best possible combination. This will allow you to bargain a better rate of interest, tenure, and other charges of the loan that you are applying for.